Hey friends, welcome back to the channel. I'm sure that you must have heard of different kinds of fund, be it index fund, mutual fund, hedge fund, or exchange traded funds. But what are these different kind of fund and what are the differences between them? Well, in this video, we are going to cover several points. First, we'll start with what is a fund, what are the different kinds of fund, how they are managed, what are the risks and fees associated, what are the strategy that they use, and most importantly, who they are really meant for. So first, let's understand what is a fund. Now, let's say you and your friends are throwing up a party, but you yourself cannot afford different kind of things. Maybe it's decorations, food, drinks. So what you and your friends do is you contribute individually certain sum of money and you have a pool of money which then you can use to buy all these things, and you personally don't have the overhead of buying all these things. Investment fund works in a similar way. It raises money from different kinds of investors, and using that pool of money, it invests that into different kinds of assets, be it stocks, real estate, commodities, bonds, etc. Now, you on your personal level don't have to worry about where to invest and at what time to invest. Rather, you are giving your money to those investment funds to invest on your behalf in exchange of a fees. Now, let's understand what are the different kinds of fund. First, we are going to start with the index fund because this is, I think, the most popular fund on the internet. And you must have heard of different finance influencers saying that invest in an index fund and just forget about it. Now, investing in an index fund is a no brainer. It doesn't try to pick any winning stock and it simply invests in a list or index of companies. But what does this index mean? So, index is simply a sample group. It is a list created to represent a certain part of the market. For example, in the United States, we have S&P 500, which represents the 500 biggest companies in the United States. Then we have Nasdaq, which is the group of biggest tech companies. Then we have Dow Jones, or simply the Dow, which is the group of industrial stocks. Similarly, we can have different kind of indexes. There can be indexes specific for small companies, international markets, or emerging markets. So investing in index fund works on this principle: no picking, no guessing. So this is simply a passively managed fund, and hence it has a very low fees. So you can expect a expense ratio of anywhere between 0.02% to 0.2%. So these are the yearly charges. Now, investing in these kind of funds give you a diversity. Your money is invested in different kind of assets and a variety of stocks. So if one stock is not doing good, there are others to diversify its risks. Now, one thing to note is that these are priced once a day, which we call as NAV, or the net asset value, which is calculated as total assets minus the expenses divided by total number of shares a fund has. Now, these funds are actually priced when the market closes, which is called as the cutoff time. And for example, you placed an order, let's say during the market hours or 11 a.m. It will not be processed at that time. It will be processed when the NAV is calculated after the market closes. Now, depending on the fund manager that you have chosen, there can be a delay. It can take maybe some days to process your order. So this system makes it very simple and consistent. You don't have to control the price, and it is best for the individuals who are in the investing game for the long run. And talking about why are they so popular, it is simply because of the low cost and the low effort, and historically they perform well over the long term. And you might have heard of Warren Buffett as well praising these kind of funds for the most of the investors because it is very difficult to outperform the market on a consistent basis. Now, let's talk about what are mutual funds. Now, you may find it similar to the index funds as they are also raising money from investors and then investing it across various asset classes. But what's the big difference is they are actively managed. There is a fund manager or sometimes an entire team that are working hard to actively decide which asset to buy at what price and what time to beat the market. Now, this may sound impressive in theory, but consistently beating the market is not that easy. Moreover, active management brings a higher fees. So the common expense ratio that you can expect from these funds can vary from 0.5% to 1.5% or sometimes even higher depending on which fund manager are you using. Also, some studies have shown that many mutual funds don't even consistently beat the market. So what is the reason people are still investing in mutual funds? Well, in my opinion, there can be several reasons. First is people could believe in some kind of strategy that a specific fund manager is using, or they want the exposure to some specific kind of industries or stocks or some asset classes. Basically, they are diversifying their personal portfolio. Like the index fund, they also are priced once a day, and your order will be processed after the NAV or the net asset value is calculated. Now let's talk about what are hedge funds. Now these funds are completely different from index fund, mutual funds, and the ETFs. The word hedge comes from hedging the risks in finance, but in reality they are chasing higher returns, and they do it by using more aggressive, complex, and risky strategies. The other difference is that they raise money only from accredited investors or wealthy investors and institutions, and they invest it in a wide variety of assets, be it stock, bonds, derivatives, currencies, commodities, etc. And they use risky strategies like short selling, leverage, derivatives, high frequency trading. And if you are interested in understanding the difference between hedge funds and HFTs, you can have a look at my this video. The hedge funds are actively managed, and these are managed by fund managers who have more freedom to make bold investment moves as compared to mutual fund managers. And this leads to huge profits, but on the other hand, exposes their investments to huge losses as well. So because of that reason, these are only open to accredited investors and institutions. And talking about the fees, hedge funds work on the famous 220 model, which means 2% for the management fees and 20% for whatever profits that the fund made. Now, these funds aim for much higher returns, but that also comes with a higher volatility. Now, let's talk about the ETFs or the exchange traded funds. So, these are the funds that are kind of hybrid between the stocks and the funds. Now, they are similar to stocks because they are traded on exchanges and they are valued in real time. So, you can buy them as you buy stocks, and they're similar to funds because they raise money from different investors and then invest it in different kind of assets. So you can expect the expense ratio to be in the range of 0.03% to 0.75%. Now, in conclusion, if you are an everyday investor and want to keep your risk as lower as possible and want to diversify in different asset classes, index funds or the ETFs are best for you. And if you are interested in some specific industry or you are interested in some funds manager specific strategy, then the mutual fund is best pick for you. And talking about the hedge funds, these are not for the everyday investors. These are only created for the wealthy individuals and the institutions. So I hope you understood what are the different kinds of fund, what are the differences, and how they are managed and who they are really meant for. So this was today's video. See you in the next one.